The next market crash isn't a matter of if, it's a matter of when. Since 1928, there have been 12 times when the S&P 500 crashed by 30% or more. And there have been 20 times when the market crashed by 20% or more. That's about every 5 years, which means if I live till I'm 90, and I'm 32 now, that means there's about 11 market crashes in my future. Market crashes are inevitable, so you better get comfortable with them and learn how to prepare yourself to survive and thrive during a market crash. I've seen too many people get totally blindsided by market crashes. They go deeper into debt, they dig themselves into a financial hole during recessions, and I do not want that to happen to you. That's why in this video, I want to share with you 6 ways to survive the next market crash. So let's get started. Survival tip number 1 is to first have an emergency fund. An emergency fund is a savings account where you set aside enough money to cover you for at least 3 months worth of living expenses. The point of an emergency fund is to not have to dip into your retirement accounts or, God forbid, go into debt if life throws you a financial curveball. I mean, just think about what happened in 2020. Millions of people got laid off. If they had no safety net, no cash set aside, imagine how hard it must have been for them financially. Probably a lot of people got into more credit card debt, had to borrow money just to pay the rent and survive. That's why you need to have an emergency fund. Imagine this scenario. One day you get laid off and you have nothing in savings. So you either have to go into debt or withdraw from your retirement accounts to pay your bills. Obviously, going into debt is not an option. So you'll probably end up withdrawing from your retirement accounts. That means you'll have to pay a boatload of penalties. And also, if the market is down at that time, you're going to have to sell your investments at a loss at a time when it's actually the best time to be buying, not selling. So this is a worst case scenario that I wouldn't wish upon my worst enemy. You want to sell your investments because you want to, not because you have to. Typically, when you're selling your investments because you want to, you can get a good price because you can wait for a time when the market's high because you have the luxury of waiting and selling only when it's beneficial to you. But if you're selling because you have to, because you don't have an emergency fund and you need to pay your bills, then you're probably going to be selling at the worst possible time, locking in huge losses, and it'll be a very large setback for you emotionally as well. But not if you have an emergency fund. Having cash reserves means you can sleep well at night, live off your fund if you need to, wait out the crisis, and hold on to your investments until the market recovers. Once you have an emergency fund, it's also a good idea to set aside what I call a market opportunity fund. Let me explain. A market opportunity fund is extra uninvested money that you have sitting in your IRAs or investment accounts or some other account. This is money you use to take advantage of a market crash as soon as it happens. This is totally optional. Definitely nowhere near as important as having an emergency fund, but if you do have some extra cash, when the market's crashing, a lot of stocks go on sale. And the only way to benefit from that is if you have some extra cash to deploy. For example, back in March, when coronavirus was blowing up and the markets were pretty much in free fall, I had about $5,000 sitting in my Roth IRA as uninvested money, and that was kind of my market opportunity fund. I was able to use it to buy some more index funds, not exactly at the lows or the bottom. I didn't catch the market bottom, which is hard to do, but I did get in at about 20% cheaper than the highs. Let's say you did catch the market bottom and you bought an S&P 500 index fund at the very lows on March 23rd at 2,237. Your money would have gone up 44% over the next 6 months. That is incredible. That normally takes years to make that much of a return. But the point is, you can only take advantage of opportunities like this if you have some dry powder set aside. And that's what the market opportunity fund is for. Now, if you're already retired and you're living off investments, instead of a market opportunity fund, you'll probably want to have what I call a market crash buffer fund. Typically, when you're retired, you sell off a little bit of your investments each year to cover your expenses. But if the market crashes early on in your retirement, selling off your investments are going to make a huge dent in your nest egg. And it'll make it more likely that you'll run out of money in retirement. This is called sequencing risk, and a market crash buffer fund protects you against that. If you're retired, you always want to make sure you have at least the next 2 years worth of living expenses in a savings account or a money market account or something that doesn't fluctuate with the market. That way, you're not completely at the mercy of the stock market's ups and downs. The third way to survive the next market crash is to be robotic with your investing. In the words of Warren Buffett, we don't have to be smarter than the rest. We just have to be more disciplined than the rest. And the best way to be disciplined about anything is to automate it as much as possible. I'm a big fan of automated investing. Whether you use a robo-advisor like Wealthfront or Acorns, or whether you go with a DIY brokerage like Fidelity, Vanguard, or Schwab, or Robinhood, by the way, they all offer ways to automate your investments so that a fixed dollar amount goes from your checking account into your investment account every single month. I can't remember who said it, but there's this funny saying that the stock market is the only business where when the product goes on sale, all the customers run out of the door, which is so true. If the price of groceries were to crash, everyone would be loading up in the store while things are cheap. But when the market crashes, everybody wants to run out the door and sell instead of buy. That's just human nature because humans are irrational. We're emotional beings. We all know that we should buy low and sell high. And it's easy to look at a historical chart and say, oh, I would have bought here and sold there. But hindsight is 2020. When the market crash is actually happening to you, it will always feel like it's too late to sell and too early to buy. It takes a lot of guts to invest when the market is crashing, and even the smartest investor might talk themselves out of it. That's why I think you should set up a monthly investment of, say, $200 on the first of every month and just let it run in the background, rain or shine. If you put this in place now, before the next market crash, you'll benefit by scooping up a bunch of stocks cheap, all without lifting a finger. This automated, robotic way of investing is known as dollar cost averaging, and I talk about it in detail in this video right here. Not only this, but if your investing is all automated, you don't have to look at your account all the time. The more often you look at how your portfolio is doing during a market crash, the more tempted you'll be to sell everything and go to cash because it's just too scary to look at. So that's a terrible idea, obviously, because if the market rebounds 9% the very next day, which is exactly what happened on March 13th, 2020, by the way, right after a 9% down day, you're going to be kicking yourself. So rather than dealing with all these convoluted emotions, just be disciplined, automate, and invest like a robot. The fourth way to survive the next market crash is to create multiple income streams. If there's anything we learned from the pandemic, it's that you can't rely on your job, or basically that life is so unpredictable. I mean, who would have imagined in their wildest dreams that entire cruise ships would be sitting empty and entire industries would shut down, airlines, restaurants. And when a market crash occurs, it's usually because the economy is falling apart at the same time. This means that job layoffs tend to happen a lot more right when people are under the most financial strain. The hardest hit industries this time were obviously hospitality and travel, and most people whose only source of income was in these industries lost pretty much all of their income. That's why if you want to be prepared for anything, you want to diversify your income streams. For example, let's say you're a restaurant worker who got laid off during the pandemic, but you also had a side gig doing freelance, photography or graphic design. You would have lost your main source of income as a restaurant worker, but you'd still have something coming in from your side hustle. This time around, it was hospitality and travel that got hit by the pandemic. Last time in 2007, 2008, during that market crash, it was banking, real estate, financial institutions. Before that, in 2000, when the dot-com bubble burst, it was all the tech companies. So you just never know which industry will be impacted, and it could be yours. If you have all your eggs in one basket, all in one industry, in one job, you're very vulnerable. If you diversify your eggs in different baskets and have multiple income streams, you're going to be much more resilient. Also, try to build at least one income stream that you can do online from home, so that if a lockdown or something like that happens again, you can still have some money coming in. You want to start this early because it takes time to build up reliable income streams. It does mean you might have to learn some new skills, invest some time and effort up front, but in this day and age, with things changing so fast, I think having multiple income streams is an absolute must. I don't even think it's an option. I'll be talking about some ways to create multiple income streams more on this channel. So stay tuned for future videos because I've got some cool things planned for you. Also, you can feel free to check out this video right here, which will give you some more ideas on multiple income streams you can create. Next up, not only do you want to diversify your income streams, but you should also diversify your investments. Instead of putting all your money into just 1 or 2 stocks, put your money into at least 10 or more stocks. An easy way to diversify your investments is to simply buy an index fund, such as FSKAX if you're with Fidelity, or VTSAX if you're with Vanguard, a total market stock index fund. An index fund is a type of mutual fund or exchange traded fund whose holdings mirror that of a particular index. They tend to hold hundreds and sometimes even thousands of different stocks, and owning one of these is like owning a piece of the entire economy, because the economy is made up of a lot of businesses, right? So if you own an index fund that has all the company's stocks in it, that's like owning a piece of the economy. This is much safer than putting all your money into one stock that you don't know much about. Of course, if you know a lot about that stock, that's a different story, but most people aren't able to do that. As an extreme scenario, imagine you had all your money in one airline stock, such as American Airlines, and then the market crashed. So at least in early 2020, you would have been down almost 70% from the beginning of the year. Whereas if you had all your money in a diversified index fund, such as an S&P 500 fund, since the S&P 500 contains many different industries, including industries that actually benefited from the crisis, such as tech stocks, then you would have been much better off. In addition to diversifying within stocks, you can also diversify into other asset classes as well. Instead of holding all your money in just stocks, consider adding some bonds, some real estate, other assets. Once again, you can do this pretty easily by buying a bond index fund or a real estate index fund. All of these will hold a different mix of assets. For some ideas on which specific index funds you can buy to diversify, check out my Fidelity Index Fund cheat sheet right here. It's really good. It'll give you a rundown of all the different index funds you can buy, how to diversify, and all that. The link is right below this video. Last but not least, reduce your debt. The most dangerous thing to your finances is fixed expenses. You can always cut back on groceries, going out, even housing if you really needed to, but you can't cut back on your minimum debt payments. You can always move into the basement of your parents' house, crash with a friend, get a roommate, or live on rice and beans if you need to, but you can't skip a student loan payment or a credit card bill. Otherwise, creditors are going to start coming after you and your credit score will take a huge hit. Sometimes these are impossible to recover from. If you have a mortgage, you could even lose your house if you miss a payment. So the scariest thing to have a lot of during a market crash, in my opinion, is debt. One of the best things you can do to prepare yourself for the next market crash is to pay down your debt, or at least not add to it, while the economy is doing well and while you can still count on reliable income. Having no debt might not be realistic, but have as little as possible and you'll be in a much stronger position to survive the next market crash. The issue with debt goes for stocks that you invest in as well. If you invest in stocks of companies that have a lot of debt, they're probably going to lose a lot of revenue during a market crash or a recession, but they'll still have these huge fixed debt expenses. Think about airlines. It's a capital-intensive business, and airlines often borrow tons of money to fund their equipment, airplanes, and operations. So when coronavirus hit, their revenue basically went to zero, yet they still had all these huge lease payments to pay for their aircraft, loan payments to make, etc. If it weren't for the government bailouts of airlines, a lot of them would have gone bankrupt and their stocks would have pretty much gone to zero. So let's recap. The 6 proven ways to survive the next market crash are: first, have an emergency fund. Then, set aside a so-called market opportunity fund to take advantage of cheap stocks during a crash. Or if you're already retired, a market buffer fund to protect you from having to draw down your nest egg at a bad time. Next, be robotic with your investing by dollar cost averaging and automating everything. That way you don't make emotion-based buy and sell decisions. Then create multiple income streams, since you never know which industries might get hit by the next market crash. Also, diversify your investments so that you don't run the risk of getting caught with the single worst performing investment during a crash. And finally, reduce debt, because monthly debt payments are the one thing that's pretty much impossible to cut out from your budget. This is a snapshot of a bulletproof financial house. Going into a market crash, if your finances look like this, you've got nothing to be afraid of. Even if yours doesn't look exactly like this, there's still a lot you can do starting right now to secure a better future. No one knows when the next market crash will happen or how bad it will be, or who knows, maybe during the posting of this video, the market's already crashing. But true confidence and security doesn't come from actually knowing the future. It comes from being prepared, no matter what the future holds. In a world of so much uncertainty, you can still have a lot of certainty if you prepare. Thank you so much for watching. I post new videos every Wednesday, so be sure to hit that subscribe button for more videos about making, saving, and investing money. And I'll see you next week, same time, same place. Bye for now.